Choppy week for the monetary precious metals, both beginning last Sunday evening in Asian markets down, yet they are closing this week off with some strength. Gold looks to be finishing this week with the spot price just over 1,300 fiat Federal Reserve notes per troy ounce, while the silver spot price appears to be finishing around $15.40 US dollar per troy ounce. This week we have a returning guest to the podcast, one of the co-authors of the free information-packed In Gold We Trust annual report. Ronnie Stoeferle drops by to share with us some recent highlights and notes from their organization's annual meeting. Our week's guest and myself, we will be right back after this brief, limited time 2019 Roaring Lion silver coin offer from our show's sponsor.
Hey there, Silverbug. What do you get when you combine SD Bullion and the New Zealand Mint? You get the lowest price silver coin ever released to the world. Introducing the Roaring Lion, a 1 ounce, 4 nines fine silver coin with micro engraving security that retails for lower than some of our competitors sell silver bullion rounds for. Check out this magnificent beast, the Roaring Lion silver coin, at sdbullion.com/roaring. That's sdbullion.com/roaring. All right.
Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week is a returning guest. He's co-author of the annual In Gold We Trust report from Incrementum AG. Is Mr. Ronnie Stoeferle. Thanks for coming on our show.
Hi, thanks for having me again.
Hey, Ronnie, your organization just published some minutes from your advisory board meeting called Monetary U-Turn. When will the Fed start easing again? Now, of course, we're going to backlink this free report in the show notes for listeners, but can you give them a bit of a background on what items were covered?
Yeah, of course. If you're not familiar with our advisory board, it's a quarterly discussion about markets, not only gold. I would say it's mostly macro, also about politics, and then we usually invite special guests. So we had really well-known gentlemen like Ben Hunt, for example, John Hathaway from Tocqueville. We had the guys from Gold Money, Royce Bach and Josh Crump. We had Luke Roman. We had Kevin Duffy, Brent Johnson, Grant Williams, Paul Milcrest, Mark Yusko, and this time we had Trey Rake from Sprott, who is in the gold market and especially analyzing mining stocks for more than 20 years. And we discussed with him as well as with our permanent member of the advisory board, Jim Rickards. I would say the macro picture, and especially our current view on gold and mining stocks in the light of central bank policy. And our main thesis has been for the last couple of months that this end of the, let's call it the liquidity happy hour that we have seen for 10 years, that this safety net that central banks made with low rates and 20 trillion US dollars printed out of thin air, they're removing this safety net. And actually, 2018 was the first year when the biggest central banks reduced their balance sheets in total. And of course, we have seen fourth quarter 2018. We have seen the consequences, and I think it's really astounding. We haven't expected that. The message from the Federal Reserve recently was that they basically they confirmed this U-turn and the mea culpa, if you want, in the aftermath of the December meltdown has been pretty fast and furious. So we have seen that The Fed is now going to announce an earlier end to its QT program. There will probably be no rate hikes this year. The market is even expecting lower rates going forward. The ECB is set to unleash a fresh TLTRO. The PBOC, People's Bank of China, is back into credit stimulus. BOJ is becoming more dovish. Royal Bank of Australia turning dovish. Bank of Canada turning more dovish. So though that's a clear trend, and I think James, it's no coincidence that those three letters MMT are really picking up in momentum at the moment. I haven't heard about MMT for quite a while, and now everybody is talking about MMT. And I'm a bit I'm not a big supporter. Sure. It basically stipulates that money grows on trees, which I wouldn't see that way. But in a nutshell, it seems that this monetary U-turn is happening. So we have seen that market participants, financial markets, companies cannot really deal with only barely higher rates and less liquidity. So we should expect recession risks getting bigger and bigger in the next couple of months. And of course, the central banks will step in. They will step in aggressively. We clearly expect another round of QE in the US. We expect much more drastic measures taken by the central banks, and that should make a pretty good case for gold.
Right. Well, Ronnie, we're recording this interview on Tuesday, March 5th around 10 a.m. Eastern Time. And thus far in 2019, we've seen strength in both silver and gold prices to begin until the recent rollover in prices last week. What are you seeing in terms of their price action at the moment?
Well, I would say it's clearly disappointing. I mean, we all knew that gold was overbought, that the sentiment was extremely positive. No matter which sentiment survey you follow, Kitco Gold Survey, we had the gold barometers, we had DSI and so on. They were all pretty bullish, but also Commitment of Traders report, which is still, of course, kind of lagging. I think that the last one that we received was from February 19. Right. But we are seeing that that large speculators, so hedge funds and money managers, they have been building long positions. From my personal experience, I haven't had so many calls from journalists for ages, like in the last couple of weeks. So sentiment was really positive. Mm-hmm. Now, I would take the recent price action with a grain of salt. I think it's in dollar terms we're up 0.5%, not that dramatic. But in Swiss franc terms, we're up 2.4%, and I'm following gold in Swiss franc terms quite closely. In euro terms, over here, that's important. Of course, we're up 2.8%. So it's not that bad, and we shouldn't forget, gold was really in a strong uptrend since August, I think 15 when we made the lows at 1160. So we basically went from 1160 up to 1340, 1350 in that time frame without any bigger correction. Mm-hmm. So it's pretty normal. Mm-hmm. But what really makes me confident is the fact that when I'm talking to institutional investors, they're all on the sidelines. I think Q4 2018, when basically every asset class was smashed, I think this was kind of the sign for many institutional players to reconsider gold. Mm-hmm. Now, they all said, those guys, they don't buy the dip. They always buy into a strengthening trend. They all said, okay, if we go above that 1360, 1380 resistance, then we gonna start piling into gold. Mm-hmm. Now we haven't made that again, but I think when we are over that level, I think this will be the second stage according to the Dow theory. So I did my CMT, which is kind of the equivalent to the CFA. So I learned quite a lot about technical analysis, and I think the Dow theory is saying that there are three phases of a trend. First, the accumulation phase, when media sentiment is extremely negative, when only contrarian investors buy into something, when they basically buy into the falling knife. That's the first stage. Then you've got the public participation phase. That's by far the longest phase, when the media picks up, when everybody is getting more upbeat, more positive, when analysts raise their price targets and so on. I think we're at the beginning of this second stage of this public participation phase. And then, of course, third phase is the distribution phase, which is the mania phase, when everybody is bullish, when analysts permanently raise their forecasts. That's this mania, that speculation phase that we're seeing in every trend right at the end.
So looking out a little bit longer term, I mean, you mentioned in your meeting notes that you sent over to me that we'll backlink in the show notes that you're seeing a potential rollover in the gold-silver ratio. It looks like we peaked at 87 late last year. It's now around 85. When this next bull market, this mania phase that you're talking about, when that occurs, when that peaks, I mean, are you expecting to see this ratio tighten beyond its 2011 low point? I mean, that was like around 33. I mean, do you foresee that potentially going into the 20s or teens for a time frame?
Yeah, for me, I would say that silver is kind of the perfect sentiment indicator for gold, because you remember back in the days in the bull market, everybody who was bullish on gold was even more bullish on silver, and it's a bit like with Bitcoin, and then at the later stages everybody only cared about those altcoins, the smaller ones, the more volatile ones, and I think that's fairly normal within a trend, that people they've got growing confidence in an asset, and then they really look for more more volatility, more leverage, and therefore seeing silver as a sentiment indicator on gold, from my point of view, works pretty well. As you know, in our incrementum inflation signal, the gold silver ratio plays a crucial role, because every time we saw a major gold bull market, the gold silver ratio actually fell, so silver was outperforming gold. At the moment we're seeing it's not really convincing yet, but I think going forward, if one is really taking the kind of still contrarian stance, being bullish on gold, I think being bullish on silver is even more contrarian, and we know that gold. In gold, I think investors' demand will really be the deciding factor going forward. And last year we saw for ETF demand, which is, from my point of view, it's representative for institutional players, because for them it's kind of convenient, and due to legal restrictions it's best to buy the ETFs. Their demand was like 8 billion, which is nothing, and the silver in silver it's basically non-existent. So I think that if there's really institutional money coming into the sector again, into the silver sector, which is significantly smaller, then it's going to have great consequences for silver. So I don't believe that gold silver ratio at 15 is kind of the natural level for the ratio.
Sure.
Because every time we had a bimetal standard, so not a gold standard but a gold and silver standard, every every time we abandoned that, the market realized that actually gold is more precious. So the gold silver ratio rose. So I think it would be normal to have some sort of a mean reversion, so to go to the 40s or 50s in the gold silver ratio. Of course, I cannot rule out that we go to even lower levels, but I don't think that 15 is like this level, this natural level that we will have to see at the end of the trend.
Right. Now, there's still a large crowd of extrovert market callers who are calling for massive U.S. dollar strength to come. I mean, we're talking in the medium term, the next few years. These people are calling for the dollar to get much stronger versus other currencies. But you juxtapose that against even what President Trump said this past weekend and his current disdain for how strong the U.S. dollar is. What were your thoughts about what President Trump had to say about the fiat U.S. dollar currently being too strong at the moment?
Well, I mean, I think first of all the fact that not only Donald Trump but also Steve Mnuchin are criticizing the Federal Reserve and Jay Powell, especially, I think that's really some sort of a sensation. We haven't seen that in decades.
Right.
So I think he kind of wants to develop some sort of a scapegoat for a recession.
Right.
Actually, the US dollar, from my point of view, it should actually be much stronger compared to the euro. Now we're like 113. We are seeing massive rate differential. We're seeing, unemployment numbers being significantly lower. We're seeing economic growth being significantly higher in the U.S. We're seeing that the banking system is more stable. So compared to the eurozone, the U.S. is how do you say? I mean, it looks
better, obviously.
It looks significant. The cleanest, dirty shirt. I think
Right.
that's the saying. So therefore, I wonder why the euro isn't significantly weaker and at parity. So I don't know, but I haven't met or seen or heard any euro bulls. It is so obvious. Everybody is so bearish on the euro, while all the problems that we're having over here with, of course, with Italy, with Spain, with France, with Germany even being on the verge of a recession, with Deutsche Bank and so on. I mean, that's already priced in. We all know that the Brexit is gonna happen. In what way, nobody really knows, but I think there will be some sort of a compromise. So from my point of view, actually the dollar should be significantly stronger, and the fact that Trump is now criticizing Jay Powell again, I think that clearly tells me that he wants a weaker dollar. I mean, that's not a secret. And for the reindustrialization of the United States, of course, he needs a weaker dollar, and that might also be some sort of a part of a trade deal that they're currently negotiating with China. And we're even writing for the upcoming In Gold We Trust report about a Plaza Accord 2.0 agreement. Perhaps something like that might be on the horizon, because actually weak dollar would be helpful for basically everybody. Yeah, it would create some inflation that Trump and the Fed desperately want to create. It would help emerging markets. It would help China. So perhaps some sort of a deal, an agreement like the Plaza Accord in the 80s might be in the cards.
Right, and that's exactly where I was going. Was currently China and the U.S. have those trade meetings, and of course currency is like key issue, right? I mean, obviously the theft of IP and all that other stuff is important, but obviously the currency agreement is crucial, I think, for both economies. But we're going to move on, and you sent me over an everything but commodity bubble chart that we've all been staring at for the last few years, thinking about when that reversion happens, how good that will be for those that are commodity bulls. I mean, it looks like we're bottoming out and regressing back to the mean at some point in the 2020s, it's looking like. That said, I mean, just this past week, I saw that the CME Group extended their non-U.S. central bank clients further discounts to actively trade in our commodity price discovery markets. I'll send you that link after we have the interview so you can see it. It's it was supposed to end at the end of January 2019, but now it's extended to the end of January 2020, and Lord knows how much longer they'll extend this. It's obvious they are buying time, right? I mean, just getting ready for these types of agreements that we've just discussed. How are you feeling about commodities into the 2020s? When is that reversion going to occur? When are we going to see that thing snap back and rally back at least toward the mean and perhaps even beyond?
Yeah. I mean, that's a major part of our monetary U-turn thesis, because if you have a look at those at this chart, it kind of coincides with dollar peaks and dollar troughs. So every time the ratio bottomed, we have seen a pronounced dollar weakness in the years ahead. Right. So and of course every time it went down again, so stocks outperformed commodities. That was basically the beginning of a dollar bull market. Now I think just have a look at most recent comments. The European Commission, they just slashed their growth forecasts for all major European economies by a full percentage point, and they said that the macro risks for the entire continent are viewed as substantial to the downside. Then, of course, we've got the People's Bank of China that already become very, very aggressive in fall. They were lowering their reserve requirements, and now they're also adding massive fiscal stimulus. So I think this U-turn that the Chinese actually started will also coincide with a change of the trend in commodity markets, having a look at the sentiment, not only in precious metals, but especially in industrial metals, but also in energy, for example. It's again extremely bearish. Nobody's interested in that at all. So I think it's from a risk reward perspective. It just looks interesting.
Sure.
And the most important law in financial markets and in life probably is mean reversion, and if we mean revert, or if we even go to new highs in this ratio, I think this is gonna be a great trade, a great long-term trade.
So this coming May, the end of May 2019, you guys are again planning on publishing your annual In Gold We Trust report, and you give it out for free. So, and I know you're doing it in multiple languages. Can you give us a preview? I know you're really busy getting ready for this, so maybe a little bit of a preview of the free content that listeners can look forward to finding there.
Of course. This is for me personally. That's the biggest or the most challenging and demanding time of the year, because from now on until end of May, we're basically working on the report 24/7. It's a team of 15 people nowadays. Researching, layouting, writing, translating, proofreading the report. It will be published on 28th of May. In German and in English, but also for the first time in Mandarin. Nice. It will be published in a extended version, the XXX version, as we call it. That's really, if you can spend some time on reading and studying the topic, it's gonna be definitely more than 200 pages again. And then there's also going to be some sort of a compact or light version if you don't want to spend too much time on the topic. But I think we've got some really great chapters lined up. We will have, for example, a chapter about hyperinflation by Professor Steve Hanke. We will have an interview with Fofoa, friend of another, the free gold theory, which is really, really interesting. Then we'll have an interview with Jim Rogers. about China. We will have a big chapter on de-dollarization. We will have a chapter about portfolio characteristics of gold, focusing on the different stages of a recession. At what stage does gold perform best? Then we'll, of course, write about the mining space, how artificial intelligence, technology changes the mining space, but we will also write about ESG, which is a really big topic, and it's for some investors it's not possible at all anymore to invest in mining companies because it's not ESG compliant. Then of course we will write about the topic of inflation versus deflation, about central banks, about Plaza Accord, as I've mentioned. We'll write about gold bonds. So
wow, gold bonds. It sounds like you got a lot of work to do. we might want to end this call right now so you can get to work.
No, but the thing is, the overall topic will be trust, and it's no coincidence that the report is called In Gold We Trust. And I think that we are seeing a lack of trust or some sort of crumbling trust. Not only in politics, but people are losing confidence and trust in the system, in journalism, for example, in institutions, in the financial system, and at some point they might also lose trust in our beloved central bankers and in fiat money, and therefore I think this is going to be a really interesting topic. There will also be a great chapter about political populism and how it's kind of fed by central bank policies. So I think you and your listeners should probably take a few days off to digest the report.
Well, Ronnie, we really do appreciate you coming by this week and giving us a little bit of a heads up of the report and sharing with us the meeting notes that you were so kind to send over. And so thanks for coming on the show.
Thank you very much. Thanks for having me. And I assume that we will talk after the report is published at the latest.
For sure. It's probably in June. I look forward to speaking with you again about it.
Absolutely. All right. Thank you very much.